There was an anticipation, right, from these companies of tariffs happening, right?
Because they were thinking Trump was getting in.
Correct.
And Trump was not hiding this.
No, they were betting on that and that he was going to win, and then they wanted to import all that to get ahead of the cost increase.
Correct.
So they did that. They bet and they were right. Welcome to our Industrial Advisors podcast. You have Bill Condon and Matt McGregor, and we've been asked a lot from our clients about the activity with Chinese 3PL companies because they have been the most active occupier in the market over the last 6 to 9 months.
On the West Coast.
Longer. Yeah, on the West Coast for sure.
Maybe, period.
Yeah, New Jersey. Yeah. And so we did some research on it to just really have a good understanding of how active they actually have been.
And why
they have been so active.
Yeah.
So, and certainly the most active market they have been has been the Inland Empire, which is, the most active industrial market in the country.
Right.
So let's talk a little bit about that and dive into it.
Yeah. Well, let's start off with what that activity is in the most dynamic and largest market in the U.S., which is the Inland Empire outside of L.A. and Long Beach. 62% of deals over 200,000 feet in the last 18 months have been Chinese 3PLs.
Yeah.
Crazy.
Which is crazy. I remember Steve Belletti, who is as active as anyone in that market. We did a podcast, or we had a market overview call, I can't remember, with him, and he told us at the time, I was with a client, and he was doing an update, and he said 75% of the activity was Chinese 3PL related companies. And I was blown away by that.
Yeah.
But the facts are there.
Yeah, I think at that time, this is months ago, but it was like something like 34 of the last 37 deals above 200,000 feet were Chinese 3PLs.
Right.
So now, so we know, and then in the U.S. at large in 2024, there were 78 deals tracked by one news source. And those were all over 100,000 feet apiece, right?
Yeah.
Mainly in port cities, right? But we are mainly seeing that activity driven out of a little bit New Jersey, mainly L.A., right?
Correct.
So I've asked a lot of people this, why? And we've done some research.
And why did that activity happen?
Why?
So
where did that come from?
There was an anticipation, right, from these companies of tariffs happening, right?
Because they were thinking Trump was getting in.
Correct.
And Trump was not hiding this.
No, they were betting on that and that he was going to win, and then they wanted to import all that to get ahead of the cost increase.
Correct.
So they did that. They bet and they were right, right? And so that activity over the last 12 to 18 months.
And maybe to buffer trade wars that might get in the way of supply chain.
Correct. So just controlling the product and having
inventory as well.
Yeah, so having the inventory, beating the cost, right, from an economic standpoint of getting it in here before the tariffs were imposed, right?
Yes.
So that is what's really driving a lot of that activity.
Yes. And now you're seeing, with the tariffs imposed, and way more than they thought.
Yes.
Right? They were thinking 10 to 20%, and now it's a trade war. By the time this goes out, maybe it's 200%, but it was, I think, 125%.
Yeah.
So now you're seeing these deals, the new deals die off, right? Mm-hmm. From that perspective. But the one thing that, before we get into the kind of the dying off of the demand potentially, because obviously this is a fluid situation with the tariffs, the question that I still have that I think is unresolved is, why did they suddenly go to a Chinese 3PL model as opposed to just using the traditional firms, Maersk, NFI, Houston, whoever it is, right? Holman Logistics, all these 3PLs that normally did it. Why the influx of Chinese-based 3PLs?
Yeah, and they just may have been ahead of it, right? Mm-hmm. And looking into the future and a lot of these companies were trying to get into the U.S., have been trying to come into the U.S. as well. And this was an opportunity for them to look at the future and say, okay, this is our time, right? So they may have been more focused on it, right? And the U.S. 3PLs that are here were probably heads down focusing on the business that was in front of them and their existing clients, right?
Yes.
So that could be something to do with it.
Yeah. We also read, I think you're right on that. In addition, I think they were ahead of the curve on a way to get around that tariff from, they call it a de minimis acquisition point. And it was like something where when things are under
a certain amount,
$800, they could get away with the tariffs. Now, I'm sure Trump picked up on that, and that's going to change too, right? But they got around it. So they were getting around the tariffs, and I think they had knowledge of it or studied it.
Yeah.
And maybe some of the US-based 3PLs, not having the expertise on the Chinese tariff situation weren't in front of it. I'm just throwing that in. Maybe that's a combination of that piece. At least one of the articles we read indicated that
was part of the reason. Yeah.
Yeah. Now forecasting, I have to say, if this trade war stays, right, here's the big thing. The 3PLs that went in the IE didn't have credit. These were firms with no credit, and so instead of getting credit, obviously vacancy was down, so landlords were dropping their threshold for credit, and a lot of these 3PLs were giving 2 or 3 months of security deposit rather than one for the lack of credit.
Yeah.
Right? So now the question is if the trade wars, none of these 3PLs anticipated 125% and a massive trade war like this, does the demand for Chinese goods drop because of the expense of them? And does that mean we're getting back all this inventory of warehouses?
Yeah, it will definitely be an interesting thing to keep an eye on.
Yeah.
Right? And I think another thing to keep an eye on is, all these firms mainly sign 5-year deals, right? Give or take, right? So in 5 years, they've certainly helped that market improve because of all the activity, right?
Sure.
So rents, as a result of all of that activity, have probably creeped up to when they signed the lease. And now, like when 5 years from now, when those leases roll, who's going to be left, right? And then what do those renewals look like?
Right.
And do they stay?
Yes.
I think it's just a really fascinating thing to kind of look at over these next few years. And are they going to be main players in the market 5 years from now, like they have been over the last 18 months?
Somebody's going to win that,
Correct.
right? And the other reason why they went in, I guess, was reverse logistics, because on returns, they don't want that going all the way back.
Right.
They want it here.
Yes.
So it was changing that, not only for the tariffs, but it benefited that. We also heard in calls in preparation for this podcast, a major rumor. Let me say that again. This is a rumor, but from a good source, that Amazon is sending a lot of people over to China to try to pick up on this trend to say, don't just have these, fly-by-night 3PLs doing this. We're already set up.
Yeah.
We can handle your logistics. We can handle your return things. We already have this stable network. And so they're trying to go in and pick up where these 3PLs maybe lack the depth of coverage. And so I could see Amazon coming in and being a more foundational result for this.
Well, yeah, and there's been, stuff that has been published about Amazon getting back into growth mode, right, on the distribution side.
Yeah, and suddenly they're out there with some pretty big requirements.
Big requirements, right, across. So I think that certainly that would be illogical for them to go after some of that in their expansion plans as they're planning them out right now.
That's right.
Yeah.
And to wrap this up, we'll just say we are from Seattle. We've only seen about 400,000 feet land in 2 deals of Chinese 3PLs. There was a couple more requirements touring, but I'll bet they die.
Yeah, it doesn't seem like that. We see it. We have a bunch of product and stay active on the market and just what's going on. And there's not a lot of those requirements out there right now. You look at 75% of the Inland Empire, it's less than 1% here.
Yeah. And we called in preparation for this podcast, no deals done in Vegas, no deals done in Phoenix of any size that are, partners down there that could recall, right?
Yeah, the activity is in the IE.
That's right.
And then some in New Jersey.
That's right.
There's been some deals done there, but it'll be interesting to keep an eye on. It's certainly something that is very relevant in the market right now, so we will keep an eye on it and see how things go.
Happy Friday.